What's up? Happy Friday and Happy New Year to everybody. Let me check on. Looks like my mic's coming through there and sound looks pretty good on here. Okay. All right. No problems to start the new year. And this week has actually been a very, not a very bullish one, but we're going to talk about what level the S&P 500 has been holding on to. It's been holding on to it since the end of last year. So like always, we're going to start off with a little bit of market analysis like every week, but I want to focus on some predictions as we go into 2023. Interesting personal fact. I have been trading professionally. I've dedicated full time to trading for 10 years this month. I gave a little blurb about that in my 2022 end of year letter. I want to talk about some of these predictions in this letter. Just kind of talk about them because these are opportunities as I see them, and actually a few of these have already started playing out pretty well in just the first week. It's just the first week. We don't know what the future is going to hold, but so far, actually, so good. Predictions. You only looked at 1 minute charts all year. Well, I'm going to try to convince you that it is entirely possible and beneficial to look at the higher time frame. That's what I'm going to try to do, Base, however you pronounce your first name, if that is your first name. Like always, if you are in the chat or even joining us late, well, actually, if you're joining us late, you won't be up to date, but typically what I do is a market recap at the beginning, and then we'll get to talking about individual things. I want to hear from you all. I do this at 4 p.m. on Fridays every week except last week because it was a holiday to me. I took a holiday. And I want to talk to people. So hop in the chat if you can, if you have time, and ask questions. You can get my opinion. You may not like it if you're bullish on something and I disagree, but that's the beauty of trading. You know, we can all have disagreements. We can all think that one thing is going to do something, and ultimately the final arbiter of truth is going to be the price. Doesn't matter what I think, doesn't matter what you think. What matters is if it went the direction that you were betting. So, as always, I have a Discord. Most people charge for Discords. I do not. I just want to have a community, and slowly and steadily, I've noticed as the end of the year came, and even going into this week, people are starting to get more active. People are starting to get interested. January is a very good month to get interested. It's also a month to be careful. A lot of people are doing rebalancing. They did their tax loss harvesting before the end of the year, and here in the month of January, people are going to start rebalancing. This whole first week has been, in its own sense, very volatile. Yesterday on the S&P 500, we had a down day open to close of a little over percent, and today we're going to close almost 2% up. Now, that's kind of in the line for what we've seen throughout the past year, but as far as all years go that I've seen in these last 10 years of trading, this is still a lot of movement. So you want to stay interested, you want to position yourself for the year, but you don't want to go in too hard too fast, because one of the worst things you can do, trust me, is get yourself in a hole in the first month and spend the rest of the year trying to dig yourself out. So start small. That's what I've been doing this week. I've had some wins this week and I've had some losses this week, but I've kept them small, especially with futures. I haven't gone full futures yet. We're not doing full ES contracts. I'm taking advantage of the MES contracts, the micro, the little, just the $5 contracts, not the $50 point contracts, because I don't want to dig myself in a hole. I want to bank some profits, and that's my strategy. We're also going to talk about crypto, of course. I have a pretty big prediction in crypto that overnight was looking like obviously good. I think it's a good long-term prospect, but I'm going to talk about that as well. If you're joining late, then drop me a line. I like to answer questions, so drop me a line on TradingView. You can also ping me on the comments of YouTube, or like I said, join the Discord. It's free. I don't charge people. I just want to have a active community to share ideas. So, looks like we got some people filtered in. So I'm going to go ahead and jump into my the market recap. That's an alert from Thinkorswim. And again, if you have any questions, just stop me and we'll talk about it. Got a lot of things I want to talk about today. I want to talk about bonds, actually. I'm going to choose a fun way to talk about them because I think that's going to be an actual very interesting thing this year. It very well could be that bonds are the oil trade of this year. And I'll tell you why I think that is here pretty soon. Let's start, because most people want it. Give the people what they want. Let's start by talking about crypto. Let's clean our charts up, and I'm just going to start from the top down because this is the beginning of the year. We're even going to start at the monthly time frame, and we're going to look at Bitcoin first. So what does this look like? Well, this looks like any old bubble and bust. I mean, it was funny enough as this almost looks like old Tesla. If you look at Tesla on the weekly, where you have, this big bulbous high, and now the dream is kind of falling off. Now, I've been looking since the top over a year ago when I started posting about it for this move, this bear market of Bitcoin in particular, because let's face it, crypto follows Bitcoin, to retrace at least 75% off the high. Why? Because that's what it's done in the past, at least 75%. Right now, we're sitting at the best case for a bear market scenario, 76% on Bitcoin, from the high down to the low. The worst case happened back in 2011, 12. The worst case happened and brought us all the way down to like 90-something%. That was actually my first experience with Bitcoin. When I bought Bitcoin for $20 and then I saw it go down to $1.94. That's a big move, but it also taught me a little thing about crypto almost a decade ago, that it's volatile. And yeah, these things happen. The area that I'm really looking at this thing to pull back to is somewhere in the middle. And the middle for that is basically going to be about 85%. And that puts us nicely at 10K. 10K is also, from a price action standpoint, right about the point. Where's 10K? 10K is right about here. What I like about this is that it comes back to essentially the launch point for the move in COVID time. The September breakout happened around the 10K range, got up to the all-time high, and then busted above it. And one of the memes that people kept on repeating to themselves was that Bitcoin has never never has broken below its previous all-time high, which is true up until this point. One thing that I thought was kind of interesting is the Bitcoin rainbow chart. Now, this was a very popular indicator that Bitcoin enthusiasts, maximalists, acolytes were citing throughout the bull cycle. And I noticed in November, a little bit after the FTX blow up, that they redrew the model. Let's see, where is it? Let's see. A new dawn. As you may have noticed, the original Bitcoin rainbow chart is dead. The chart, which was based on a model developed in 2014, held for quite some time. So what happens if the model breaks, as it did, as basically, the model basically told people to start buying at 19K. That's when it got into this blue area, which is in bold right here, basically a fire sale. And look, this thing the whole time, I tried to tell people curve fitting. It's literally curve fitting. I mean, and it wasn't even that freaking good. If you look down here, back in the 2014 range, where apparently the data was supposed to be made, you had this big bust to the upside by almost more than whatever the width of one of these bands were. Well, they don't include that in the data. They just assume that because, we made the data fit the last blue lines and it has a nice curve, therefore, this is going to work. Well, it didn't work because it never was going to work. But what they did was they decided to learn from their mistake and, they redrew the model. Where now you do actually include in that 2014. You widen those bands out and, okay. Now it's basically a fire sale. We'll see if they need to redraw it again. I don't like these models. Hey, Stone Pilot, what's up? I don't like these models at all because especially when you're just going to redraw it, you're just going to curve fit it. So this is not how I like to trade. But a lot of people were basing their investment advice on this, and it was very popular to share on Twitter because it was a perma bear mantra. But nobody listened when the simple price action of November, which still holds true to this day, and no matter what you look at, where you had failures to break higher. That did not happen back in November. You should have had a lot of strength and momentum to push it up, and it didn't. And then around the time of December of last year, December of 2021, when you had that jobs report, which, by the way, we just had one today for January, when you had that, I think it was a non-farm payroll job report, when you had this Saturday, the 4th of December 2021, that response to the jobs report, that was the death knell for it. But it's hindsight now, but I cite that just to say the two things, the lessons you need to learn from this is to watch for false breakouts, basically where price should go and then it closes back inside the last high. That's what I base at least half my trading on. That is a signal that this trend should have gone and you need to get defensive. So it can also be a reversal signal in case you want to go short. So be watching for that. And then also, by and large, for the course of 2022, cryptocurrency was responding to news events like non-farm payrolls, CPI numbers, inflation numbers, because a lot of low interest rate money, a lot of debt was used to pump up the value of all things, housing prices, stock market, and cryptocurrency. And as interest rates have gone up, it's not nearly as attractive to take out money at 6%, 7% as it would be at 0%. If you put it at 0%, it's just free money, right? But now people actually have to make decisions based on risk. And maybe the volatility of cryptocurrency isn't the best option, even though it's 75% cheaper than when they were using it. That's the nature of the fads. And that's just how capitalism goes. Just got to get used to it. So that is Bitcoin. Ethereum not doing much better. I got a couple of lines here that I've drawn to show the different performances since different points. Of course, like from the June low, Ethereum is up only about 2% since the June low. Is that no? Wait, that's not right. That's from the June low. Ethereum is up 43%, pretty good, but it still has not recaptured. This is the point that I'm watching now. The point I'm watching now is the pre-FTX high. That's really kind of the defining point that we're going to look at now and for the next couple of months. How long, if and when, do we finally get back to at least the 50% of the FTX crash, or do we actually get up and break the high set before FTX? This is a major event, both in terms of fundamentals and in terms of price. And that all factors into a major event in people's psychology. Where were we at before FTX scared everybody? Have we gotten back to that point of pessimism versus optimism? That's what I'm looking at. And for Ethereum and Bitcoin, the answer is no. They have not even yet recovered their 50%. Now, there's lots of cryptocurrencies out there. I don't follow very many. The only three that I follow are Bitcoin, Ethereum, and my favorite right now, which is Monero. Monero, its own relative performance. Just last night, I had a friend text me, "Hey, Monero, look, it's going." It was. It was up about 3% yesterday, actually, where Bitcoin was actually down. Monero, on the other hand, is getting closer and closer to that pre-FTX high. It's already surpassed the 50% level of that move down. And in fact, I made a post about it where it recaptured the down move of FTX. It came back and held it as support, and now it is rising off of it. And we're going to see what happens when it gets up to 162. From the standpoint of Ichimoku, which I use to gauge trends, it is already breaking out to the upside. In other words, we have price above the cloud and we have the momentum above the cloud. We don't see that yet in Bitcoin. Bitcoin almost got itself on this upside here on the side of the daily cloud, but it failed on December 14th. And now it's still pretty much below the cloud. It is still actually trending bearish. Ethereum still a little more neutral, but it still needs to get back above that 1375 level, that halfway point where the top of the Ichimoku cloud is on the daily, just like Bitcoin needs to get above 18.5. But as I've been trying to tell people, Monero is outperforming, and it continues to outperform. The next target that I'm looking for from Monero psychologically is going to be, this is Monero versus Bitcoin. XMR is a symbol for Monero, by the way. XMR BTC. The next place I'm looking at is, see, 0.01. In other words, Monero being worth 1% of what Bitcoin is worth. Now, Monero versus Bitcoin has had a lot of volatility over its history. This is not a new coin. It is by no means a new cryptocurrency. It had a lot of volatility back in 2017 during that run up, and it has fallen off since. But in the last year alone, let's say year to date, so January, we're already January 6th. Let's go daily here. I say this because I think that people ignore things until they have popped off. Things are not popping off right now, but this thing actually is. You're seeing a major outperformance, 100%. Monero has outperformed Bitcoin by 100% over the last year, over the bear market, over 2022 when everything was going down. Monero did go down too, but it went down half as much as Bitcoin. Your money was better off in Monero. Why? Because people actually use it online. It's used in the shady parts of the dark web. There's two things they take if you want to buy things that people don't want you to buy: Bitcoin and Monero. And Monero is a lot cheaper, but it is widely accepted. It is what Bitcoin was 10 years ago being used for. It has the use case. And I think now the focus of 2023 in this bear market is going to be on regulation in cryptocurrency. You're going to see maybe not the trial of Sam Bankman-Fried, but that may not come for another year. It could take a while. But you'll start to have heard a lot of news about it. You're also going to get a steady stream of all these bankruptcy cases. We just heard this week that it's kind of a blow for the owners of, the depositors, not the owners of crypto in Celsius. They are not going to have claim to their coins. Court ruled that Celsius owns their coins. It's kind of ironic in the whole not your keys, not your coins things, but it's also kind of a landmark decision in that it's ruled to not be their money. In other words, the individual depositors of money they put in Celsius, which by the way was a crypto lending platform that people deposited crypto to earn interest on, because the expected performance of cryptocurrency, 1,000% returns, was not enough for people. They wanted to get an extra 5% on top of that. I'm not going to sell these Bitcoins. I'm going to earn interest on them. Why not? I'm expecting to make 1,000% return, but might as well get another 5% by risking everything. Stupid. I mean, seriously, I hate for people to lose money. That's why I try to teach people good risk management, but I don't have really much sympathy. I got empathy for people who lose money, but I don't have sympathy for people that take risk and then find out what that means. They took on risk to earn a little bit extra percent, and now a court just ruled that they have no stake in it. They can hope to get something back in the bankruptcy, but I don't know how that's going to go. It's all verdant ground. Pioneers in the legal system of cryptocurrency. We'll see. But as it stands now, and as it goes through 2023, you're going to see more and more news about regulation. You're going to have more reminders that cryptocurrency didn't quite work out the way people thought it was. You're not going to see bullish news on cryptocurrency. And so I think that's going to affect the optimism, and I think that's going to affect the price. I have said from the top that it's not necessarily a matter of the price that Bitcoin gets to, so much as the time. These cycles have to play out in the collective psychology, the collective emotions of the participants. And right now, the people that were willing to buy a Bitcoin at $60,000 are burned. And they're not going to be optimistic again for at least 2 to 3 years from the high. So it's not that I don't think that this could be the lowest point for cryptocurrency. But to see the kind of returns that we saw in 2020 and 2021, you need unbridled optimism. YOLO, aping in. People are going to remember that. It takes a while for people to calm down and get over things. It's like a breakup. It's like a bad breakup. It takes time. It takes time to get yourself back to a place for you to do something stupid again. So that's what's going to really come into play. Now, I do think, and I said this in my letter for 2023, based upon what I saw in 2000 and late 2018, 2019 with Bitcoin, what you saw was a low. By the way, we made a new low in Bitcoin in late 2018. The question is always asked of people, whether it's a stock or cryptocurrency, how much lower can it go? Or it can't possibly go lower. Well, I have an answer for that. The answer for how much lower something can go once you ask that question should always be assumed to be 50 more percent. That's the same thing that happened with Facebook. Facebook, when everyone was saying, how much lower can it go? Yeah. Oh, yeah. This is a this basically illustrates thanks, Jen. Crypto staking. F star find out. They found out. So what I saw going into 2019 was a resurgence in cryptocurrency. In other words, there was this secular bullish trend that happened from the bottom starting in 2019 that got a lot of people in that felt like they missed the move. They FOMO'd in 2017 thinking that they were going to now get a second opportunity at it. It went and then it didn't. And then, of course, we know what happened in 2020. You have the COVID low, which brought us back again to what people thought it could never get back to, which is basically close to the 3,000s. The point of showing you this is just like in GME, just like in the most shorted stocks, you always have this resurgence, this pump where everyone that's still holding on to hope thinks that everything's going to be okay, and they FOMO in. That doesn't necessarily mean this is going to be another resurgence. It still took the COVID crash and the low interest rate environment to recover from this second low, this second opportunity, if you will, to get it cheap. Point is, don't be patient. Be patient. One thing you need to understand about the recent run-up in cryptocurrency and Bitcoin in general being the oldest, Bitcoin has never existed under a market condition where interest rates are going up. Bitcoin has never existed under a recession, a true recession, a long recession. We had the 2020 COVID recession, but not a 2008 recession. The 2008 recession was why Bitcoin was invented. It has not existed in that time. So it's really unknown territory, unknown market conditions. We don't know. But be patient. All that being said, the best store of value for the last year has been Monero. and it continues to outperform Bitcoin. As regulation starts to take more of the forefront, I've heard the argument from Bitcoin maximalists. Just about every Bitcoin maximalist comes back to me with this challenge, and I'm going to try to steelman it. If privacy coins obfuscate people's usage of it, then that's going to be one of the things that regulators go after. And Bitcoin, because it is trackable, is going to be okay by regulators. In other words, regulators, if they are going to ban something, the first thing they're going to ban is privacy coins. But they're going to leave Bitcoin alone because they understand it. I don't know if that's true. What I do know is that one of the key focuses of the current regulation, you had New York State either last month or November, ban proof of work mining done with carbon producing or fossil fuels. I'd have to look it up. But basically, New York State passed a law saying that you can't do proof of work if it's not green. A big push against Bitcoin, because it is proof of work, and it will always be proof of work. They're not going to change that politically inside the development, is the energy usage and the carbon it produces. Climate change is a big hot button issue. You can get people to ban something if you say that it's going to hurt the environment. And that is going to be the most likely vector of attack for regulation. Now, that being said, Monero is proof of work, but it's done with CPU mining rather than ASICs, which stand for, I don't remember the acronym. Basically, they have dedicated circuits, dedicated chips that only mine Bitcoin. And then what you do to make it economical for you as a miner is you invest in energy-intensive, industrial level mining operations. Well, you can't do that with Monero. It's different. The proof of work it does is a lot more democratic, but it is proof of work. So it does probably fall under these regulations as well. So the most likely vector of attack for cryptocurrency from regulation is, of course, going to come in the form of taxes, securities, SEC, but probably also proof of work. That's what I see coming about. But the good thing about Monero is nobody knows if you have it. So that's the crypto scene right now. Let's do a look at the market. Jump into that. By the way, if you have any questions, if you want to challenge me, if you want to tell me I'm wrong, tell me that I don't get Bitcoin, even though I've been doing it for 10 years, tell me. Let's talk about it. I like to talk and interact, break down that fourth wall. Again, I have a Discord. You're invited to join. Find the links below. It's free. I just want to build a community. It's been getting a lot more active as this January comes in. I'm glad to see that. That's actually bullish for the market too, because things have been very slow when the gains have not been there. But it's January. I think people are thinking a lot differently. It's the start of a new year. I'm happy to see it. Come hang out with us. All right. So the key level, let's talk about the stock market now. The key level, let me clean up my charts. Actually, let's start fresh. Wipe everything out. Talk about like I talked about it in my end of year letter. ES, which is the S&P 500 E-mini futures. This is what I gauge the stock market based on. I like it because it's not SPY, because the SPY closes. ES is open 23 hours a day, 5 days a week. Either way, it's better. Okay, from the COVID low, March of 2020, up to the all-time high of January 2022, in October, we came down to touch that 50% level. That's a thing of beauty. It really, really is. SPY actually kissed it just right. That is a support. Support I look at all day. And it happened in the context of, missed it here on the S&P futures by just a little bit, but SPY actually hit it. Either way, pulled back 50% from the COVID low to the all-time high, key. And it even did it in the context of a spike. Boom. That October CPI broke the low, closed back above it. We get this rally into December. December, what does it do? December, it comes back to the 50% retracement of the all-time high down to that October low, kisses it on the December CPI news, closes back below. Now we got a downtrend. Spike to the downside, up. Spike to the, spike down, up. Spike up, down. And where does it sit right now? I've been looking at this level throughout the end of December when it first hit it. I've been looking at it the last week of December. I've been looking at it all week. On ES Futures, 38.41. That's the 50% of the October CPI to the December CPI. It has held it. And on a day trading basis, as we've been trading in our futures chat on Discord, that level has just been so consistent. Now, it looks choppy here because it is. This has been a hard market to trade. I've even considered starting to do some RSI stuff. But at several times at key points, like the morning of December 22nd, the low of Wednesday this week, and then earlier today, it has held that 38.41 multiple times. It's been such a key level. In fact, one of the cool things today, when we were day trading, on the 1 minute of ES Futures, we had this morning the non-farms payroll report at 8:30. The move started here at 8:30, draw 50% up there, and let's make this one. This is the big one, 38.41. Make it big. Boom. This is the 50% level of the last 3 months, more. Price jumps up on the price jumps up on the payroll, spikes out, comes down, holds it, hits the 50% of the move, holds it, 38.41, 3-month level, holds it, 30, holds it, 50%, 50%. The little, just a 6-point difference between a 3-month move and a 5-minute move held price in a range until it finally did a breakout to the upside to retest the top. That's how you build trading on the day trading level based on months-long level. So, Bass Koenig, this is why you got to get up above 1-minute charts. You need to find those levels that go back weeks and months because price will oftentimes respond to them on the 1 minute when you're day trading. Yeah, so 38.41 has just remained the long-term level. And even though I have to, I still got my Christmas thing on. Is it time to take down our Christmas tree? I think it is today, isn't it? This is the Three Kings Day. I think that's probably when they'll take it off. Wait, where's my thing? You're totally liquidated. Oh, that's not good. Sorry to hear that. So even though I have been assuming since the December 13th news that the market is doing a bearish pullback, probability-wise, trying to retest this October low, it has been continuously holding this support. And we really haven't broken out of this channel. We really have not. This has just been a great time for swing traders, for mean reversion traders to play the tops and the bottom of this range. I mean, you can really see it really close in the 4-hour chart right here. Bing, 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 bing. Big moves in here. Big moves. A lot of money to be made for people that do mean reversion. I really want to see trends. Yeah, that's a 75-point move. You can maybe even get like a 50 to 100 points in some of these days here. So big moves to be played in this range. But eventually we're going to break out of it. Now, which way we're going to go, I'm waiting to see. I got asked this week, which way am I going? Nowhere. I'm waiting to see what happens, and I'm going to try to ride it, catch the trend out of it. But today, again, we didn't really get any confirmation because it looks like today's price, we pierced above the high of the range going back to December the 21st, and we closed back inside it. We are still in this range, around 38.41.
Woo!
Oh, man. What's up, man? Let me turn your volume down. That was kind of loud. So, you got something to add? I'm pretty sure it'll come through on YouTube. But, yeah, people will be able to hear it on Discord. Go ahead.
No, I just You got it right. We're playing that range, and just betting that they weren't gonna make it so easy, right? Like they keep closing at the lows and popping it, closing at the highs and dropping it, and it was just a good risk reward to assume that they were going to try to at least reclaim that 38.41 at
Mm-hmm.
least, and then if they wanted to do more, you give them the option to run and take profit, or leave a runner on, which is what we did today, and then now that we're at the top of the range, went into the end of the day short off of 39.26 with some puts, into Monday, some out of the money puts in case they want to traverse again. But this probably gives us enough momentum to break the range now.
Think so. Okay.
It seems like it does, but we've been strict before, so that's why you don't not betting the farm on it.
Yeah. That's why I'm not. Yeah, I'm waiting to see because I mean the trend's going to develop one way or another. I think we'll see it, but I wouldn't. It's good to go in long on like a small risk now, but yeah, you said you got a long off 38.41 basically some way somehow.
Yeah, I pulled back off initial top of the 38.41 on the 15-minute TS and bought it there, and then took it up to 3,900 basically on the runners, and then kept options going into Monday.
Cool. I think that's a good position to be in because it does not seem to want to break this level. It's tried.
Yeah. I got some short futures and short Monday expiry options in case they want to, pull the rug out. But it seems like today was just a big put unwind. So if we keep unwinding into Monday, we should get a squeeze.
Mm-hmm. Well, I think that you have to assume also going into this year, after a bad year, we should have a good year. But a lot of people think we're going to have a 3-year bear market if they're fudding. What do you think, man? If you had to guess, what do you think?
If I had to guess, and I apologize, I'm noisy where I am, so I can stop talking if you want. It's too annoying, but
Gotcha.
I think we float up. We head up into February, and then there's some event in February, where we get those positive flows. We get everybody back like offsides to the upside, and from somewhere up there, we all of a sudden the rug does drop out. Maybe we don't make a new low, but we get one more nasty shakeout into February, March, April, and then we head back up like you're describing. I think they got to give one more good shake.
Shake everybody out that's trying to go long.
I don't know, I think so, but probably I could be overthinking it.
Who knows? I mean, I'm going to be watching the VIX 100% because VIX 20 has really captured every single of the last year, every single high side. And if we can actually break VIX 20, in other words, go below 20, I think that's going to be a sign that we're going to just trend bullishly. I'm going to miss it, but that has been one of the key things. So, I mean, VIX is down about 6% today. It's still pretty far from, well, let's call it 19, VIX 19. So if we can get like VIX 18.99, then I'm going to start thinking, okay, this market's going to be bullish and VIX is going to trend down.
Yeah, I mean, you probably already mentioned this, but until AES is over 4,200 and staying there, it's very likely we can get more pullbacks.
Yeah. I mean, if it breaks the December high that it did on the CPI, then it's bullish. You have to assume it's bullish then because it's defined itself by that.
Yeah, which, as you said, also happens to be the 50% of the low to the all-time high.
Yes.
Right? So what a coincidence.
Yeah, very much a coincidence. So,
but I could see him spiking it for a day or two, and then there's some stupid news that just cracks everybody again. Who knows?
Yeah. I'm going to talk about TLT next. I'm actually going to try and make it fun. Yeah. So, yeah, TLT. All right. So, bonds have been getting killed. And I want to do something fun. I want to do something fun to talk about what's going on here because it's been a long time since I actually studied bonds, college, and that was a very long time ago. We're going to do something fun. Hold on. Bear with me. I don't know if you guys, I think unless you've been living under a rock for the last, wait, why can't I get, oh no, don't do that to me. Okay, here we go. Unless you've been living under a rock for the last 2 weeks, you have heard about ChatGPT. If you haven't, then I'm going to show you something cool. I actually had to show this to a few people, even programmers that didn't know. Oh, I gotta log into it. Hold on a second. So ChatGPT is a AI chatbot that tries to mimic human speech, but is actually turning out to be a very threatening technology for Google, in that you can ask it not just questions you would ask Google to find you things, but you can ask it actual questions like write me a paper on the differences between the belligerents during the Napoleonic War, and it will actually do that for you. And it's really cool. So, what I'm going to ask it is this: tell me about how bonds are valued. And it's going to answer me, because I was going to do a little PowerPoint or something like that, but then I said, like, I'm just going to be lazy and I'm going to let AI actually teach for me. And so you can read here: bonds are debt securities that are issued by companies, municipalities, and governments to raise capital. They pay periodic interest to bondholders, blah, 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 blah. I really want to get into the valuation so that we can talk about bonds, and then we're going to get to TLT and the actual opportunity there in just a second. So, for example, let's say you have a bond that pays out an annual interest rate of 5% and matures in 10 years. You expect to earn an annual return rate of 7%. If you expect to earn an annual return rate of 7%, you would discount the bond's future cash flows by 7% to find their present value. And so what this means, let's ask it what it means. So what happens to bond valuations when interest rates are rising? When interest rates are rising, the value of existing bonds with fixed interest rates tends to decline. That's important. This is because investors can earn a higher yield by investing in newer bonds with higher interest rates. So why would you buy a bond with a 3% interest rate when you could buy a bond with a 5% interest rate? The 5% one is going to give you more money over the life of the bond, so it's going to be worth more. So the value of the bond, the price you would put on it, is actually going to be higher. That's why when rates go up, bond values go down, because essentially the bonds that are issued at a higher rate are better. They give you more money over time. So you still have all these old bonds that people have on their books. Maybe they don't want them anymore, but maybe they need to liquidate them. Maybe they need to raise some cash. Can't sell them for what you bought them for because people can get better. So you got to discount them. And so what's happened over the last few years, let's ask it. Well, yeah, over the last few years, not few years, excuse me, really since the Fed has been raising rates since December when they started talking about it, TLT and bonds in general have been getting clobbered. That's because TLT is the ETF for 20-year plus Treasury bonds. So the value of the bonds is going to be reflected in TLT, the value of TLT. And as interest rates have been going up, all existing bonds that have been written for the last 20 years when interest rates have been low are starting to get devalued. It's not good for bondholders. So the market's also been pricing in rising interest rates. And if you talk to someone that's really kind of fuddy-duddy, they're going to tell you that, oh, the Fed's going to have to raise it to 10% to get inflation under control. Maybe. I don't think so. We've started to see data showing that inflation is starting to curve over. The Fed is not as hawkish as it was last year. We're still expecting, I believe, 3 rate hikes this year. So they're still going to continue raising rates, but not at the same rate. At some point, the Fed is going to reach a point where it doesn't raise interest rates anymore. Wherever that is, maybe 5.75%, maybe. We'll see. I need to look at what the forecast is. But you have to remember that bonds are going to be issued relative to that rate. And you're going to have a whole generation of bonds this year that are going to be at this rate. And then maybe if the Fed stops raising interest rates, you're going to have interest rates settle off, and then bonds are going to be basically valued at what they should be. It's going to be stable. But then if the Fed starts to lower rates, because remember the inflation target is 2%, you can't have interest rates of 5%, or else you're going to stifle the economy. They're going to have to bring them down at some point once inflation gets under control. You're going to start to see interest rates for bonds go down, which means that this generation of bonds that were issued at a higher rate are going to be worth more. And so bonds and bonds that are in these ETFs and bond funds are going to start to rise in value. Bonds have been crap for the last year. But what happens when things are crap? They go down in price. And then what happens when something goes down? It goes back up. And what we saw at the end of the year on TLT in particular was one of the things that I like to trade, whether I'm day trading or just doing simple price action analysis. I call this a TS recap. What that stands for is a Tinkinson recapture. The Tinkinson is the red line component of Ichimoku. We're going to take Ichimoku off because we're not using it. But what it is a 9-period middle, 50%, because that's what I trade based on, 50%. A 9-period, 50% from the last 9 bars. It's just a measurement of where price could be doing a rebound. And from the low that was made October, let's say the week of October 24th, we're on the weekly of TLT, up until the high that it made in December, which corresponds with the inflation numbers of CPI, because inflation data is going to influence interest rates, and interest rates are going to influence bonds. You basically see kind of a similar pattern as the stock market, but a low to a high of 50% at 177 on TLT. And so either last week, or as I made a post about it on TradingView earlier this week, basically on, was it Monday? Yeah, Tuesday, when the market actually opened. We were still at that level. We actually came down and kissed it on Monday, I believe it was. And this right here is a trade just like any other, to get TLT back up to 135, let's call it, which is, again, another 50% from the high to the low. It's also some price action inflection here around 133. Within this range from 100 up to 132, I can say that's my reward on this trade, and then I can have a stop below the low. In other words, if we break 91, I'm out. This is a good 3-to-1 trade on TLT. Could take 2020, could take 3 months, could take 6 months. This is a good long-term trade to start the year based on the fundamental thesis that the Fed is going to not raise rates crazy, and eventually we're going to enter a market condition more akin to normal when it comes to bonds, where bonds will actually be a good way to park your money. Hopefully, it's that way for boomers. In fact, honestly, if you think about it this way, think about it long term. Take everything, all the crazy FUD that we've had over the last 2 years out. If the inflation target of the Fed is 2%, and what is the actual? Oh, you know what? Let's ask Open AI.
But Norok, how come this chart trades to 50% retracement levels when that's not how bonds are priced?
We'll see. We'll see. We will see.
The answer to that is because bonds are actually priced in the open market like this, in these kind of instruments, based on the same stuff as the ES, right? It's the algos, it's the market, order flows. That's all it is.
It's human psychology. I mean, we as humans price things, and we act the same way. We all need food. We all get a little crazy sometimes. We all become fearful. We all become greedy, except you. You don't feel these things. I do, and everyone else does. But that's why these things act this way, in my opinion.
I definitely feel greedy. I just don't feel the fear. That's when the proprietary indicators are firing to enter this trade last week.
Mm-hmm. Well, I'm going to keep using this methodology because it does seem to work a lot. Not all the time, but a lot. A lot. So, what was I going to ask ChatGPT? Oh, what has been the average inflation rate for the U.S. dollar for the last 30 years. The average annual inflation rate for the U.S. dollar over the past 30 years was about 2.5%. Okay, so let's say that you're a baby boomer, okay, and you're going to retire and you don't want to take risk. What do you do in a typical normal market environment that everyone's used to? You're going to buy bonds. And now, in the last couple of years where interest rates were at 0%, I mean, I own municipal bonds, I own some tax-free bonds, and the best thing that you've been able to get over the last few years in some good low-risk bonds was maybe about like 4.5%. Now you're actually going to see opportunities for people to lock up their money for 30 years, perhaps, unless the bond gets called, at 5, 6, 7%. And eventually inflation is going to come down. Whether it's this year, whether it's next year, eventually it's going to. We're also probably over the next 30 years going to have a deflationary period, probably more than one. And I remember reading a story about the Volcker area of the Fed, Volcker era of the Fed, where at one point I think the Fed, let's just keep using OpenAI. What was the highest federal funds rate? It was like around 15% or 18%. Raise the target rate to 20%. Okay, so I think that at that point you could get a 30-year bond for something around 15 to 18. I think it was 18% was when I was thinking that number. I remember some old trader talking about how they were able to lock in 18%, but people didn't want to buy that. People didn't want to buy a 30-year 18%. I think what was the highest U.S. Treasury 30-year rate? The highest yield on the U.S. 30 Treasury bond occurred on September 1981 when, 15%, 15.21%. And I remember the trader was talking about how traders were sitting there not wanting to lock their money in for 30 years at 15% because they thought it might get higher. I mean, it's crazy to think that, I mean, wouldn't you love to earn 15% on money for 30 years? Wow. But people in 1981 didn't want to take that trade. Why? Because they were influenced by the current market conditions, and they were fearful that if they locked in 15.21%, they'd be able to get 16% in a few months. So people be crazy. But eventually, we're going to get back to, just like the price of things goes up and down, so is inflation. And over the next few years, or over the next year, it could be a very good time with the interest rates what they are to lock in some bonds if you're a retiree. Now, I know 5% is not going to let you quit your job now, but for retirees, it's actually a very attractive prospect. It really is. And so I think that with all the pain that bonds have gone through, it's looking like an opportunity going into 2023. As boring as bonds are, be on the lookout for it. So that's one of the things that I'm looking at going into 2023. So
bonds don't feel very boring right now. They've already ripped 6%
from that level. Yeah, this week they're up 6%. Yeah.
I mean, if you're playing that with options, I mean, the IV on those options is so low that a 6% move with like 24% IV, you'd think the return on even like a March dated, slightly out of the money call is you're up like 150% in a couple of days on bonds.
That's a good point. Hold on just a second. Let me.
Because it's not Tesla, right? Like Tesla, you need like I think an 8% rip or something in like a day for a. And you'll get a minor move on a March option, but the IV is so low.
Yeah, IV on bonds is actually it's low. It's got a low IV rank, which means it's low compared to the last year, as well. And so it's actually below average IV. So yeah, I mean, if you're buying calls, well, the problem with buying calls with IV is that IV tends to decline as the price of something goes up. So you do want to try to get it IV cheap as you can. But it definitely doesn't. IV doesn't help you as much as if you buy a put, for instance. But yes,
Yeah.
they're cheap relative to it. I mean,
Yes, yes.
yes.
Inexpensive. You get
Mm-hmm.
a small move is a bigger return than
Yeah.
playing Tesla right now
Yeah, because
because
the
like
market's
it's so high.
still thinking bonds are bearish because they are. It's just the latest meme essentially.
Yeah.
All right, let me do a quick. I may have to. We're getting close to the end of the hour right here. Anybody got any questions, things they want to talk about? Get them in now. Um, yeah, I think base.
Not a question, but just a general
Yeah, go
observation is
ahead,
that
talk.
if you look at some of the like the bigger name tickers and just some that I've been watching this week, like Nike or a Costco, you look at like their position relative to their COVID load at all-time high, 50%. Like everything, a lot of big tickers like that, not Apple, not Tesla, but a lot of those recaptured their 50% retracements to the upside this week. While Apple, Tesla, Microsoft, actually Microsoft is right below its 50% now. Like the big tech names are the ones that are taking the beating right now. But the rest of the market, like from a breadth perspective, is actually quite strong.
Oh yeah, I mean,
If you remove those tickers, it's actually very bullish under the surface.
my watch list of the things that I'm still holding on to is doing pretty well because I'm out of all the tech stuff. And
What's that ticker that's like the SPY minus like the top five? Was it? Forget what it is. There's
I
a
don't
ticker that
know.
tracks like.
I don't know off the top of my head.
It's the equal
Maybe
weighted
maybe it's
index.
the evenly weighted S&P. I
Yeah,
know there's a ticker for that. Hold on. So
yeah, that's one of the
evenly
companies.
weighted S&P 500. Um, Invesco equally weighted S&P 500 fund. That is VDAX.
There's another one I'm thinking of, but I'm sure it's the same thing. RSP. That's what I'm thinking.
RSP.
Yeah, check out RSP.
Okay, there we go. So, okay. Um, what it's up was probably because it doesn't have Apple and Microsoft in it, right? Or it's
Yeah,
equally weighted.
it's just a more bullish looking chart when you take out those big tickers that are. I know you can't really do that in reality, but the point is that you know they're beating up Apple, Microsoft, Tesla right now after beating up everything else. But other stuff is coming up first, and those are the laggards right now. So the only spark that it's going to take is for Tesla, Apple to reclaim some key areas and just trigger like a short squeeze for this thing to just start running its face off because there's other tickers that are so bullish right now.
I hate to be
Is
that.
what I'm saying.
Yeah, and we talked about today with Tesla. I hate to be that guy, but I mean, just from a risk management perspective, I really don't like people buying the falling knife of Tesla. I mean, it still hasn't recaptured the Tinkinson on the daily, and
I won't. I'm not going to talk about. I'm a bad role model on this one.
oh, you okay? Well, I mean, a lot of people have. I mean, a lot of people see it as cheaper, but I've just seen so many of these, especially in the last year, where this thing comes all the way back to retest where people doesn't think it can. I
Yeah.
mean, it's just so common. I mean, I was actually looking at Amazon today, and it's Amazon, but I've got this level drawn from maybe a few live streams ago from the all-time low of 28 cents split adjusted all the way up to 188. This is split adjusted because it used to be four figures, but Amazon has given up its all-time 50%.
Yeah.
Closed below it last month, and
Yeah.
so that's rough.
It is, but if you look at that RSP again, it actually recaptured its 50% from the all-time high to the low of last year. It closed today above at 50%. And all I'm saying is that back to the theory of we might run up for a couple, a month. If they just kind of let those bigger tickers fester for a while, and the rest of the market starts to rise, I could see us catching a bid, back to that 4,200 level, and then we'll see what's up. It kind of all plays into that theory,
Yeah.
because the market's definitely not overall bullish, but I can see there's a good base for a bounce. Obviously, that seems very obvious today now that we kind of broke that range, but if you look the past couple of days, we were like threatening to do it for so long. Like the overall market wasn't that bearish. It's just everybody's watching Apple and Tesla and Microsoft, and they're getting annihilated.
Yeah.
But the market's not going down. Like they keep propping it up anyway. So
Yeah.
where are my bears at?
Those, well, I mean, not today. I mean, those have been those are the darlings for the last couple of years. But I really think people need to be looking at other things. I mean, just to kind of recap real quick, some of the things that I'm actually stayed in. Costco has been one, like you said, but things I picked up in the latter half of 2022. I'm gonna harp this again, talking my book, but MKTX is one that I picked up in November. This is a platform that trades bonds, and I just think that synergizes. Did you pick this up in like your IRA or something like that when we talked about it?
Yeah, I
Yeah,
still got that one.
this
I got a few.
synergizes really, really well with bonds because this the performance from it's not correlated. I did a correlation study that doesn't really work, but this is sort of like a proxy for bonds in a way because it's a platform, a tech company that you know, helps people trade bonds. They make software that people use for bond trading. Makes a lot of sense. I mean, it's up like
Yep.
5.25% today. Um, another one,
Yes.
uh, another one that I've been in since again October, up really big today. Union Pacific Transportation, really coming off that 50% pretty well, and then HSIC, which was a good swing trade, and we're gonna hopefully. This is one that I put on this week. Um, it was a 30-minute setup off of. Now the data on TradingView is a little crap when you get down to the 30-minute, but basically what happened was price came down and kissed this 50% level from the high to the October low. And if you notice, this is one of the things that I like to look for, either for price to hold the 50% level, if it's a support or resistance, but if it actually breaks above it, come back and then support it, and then use that as support to go up. And so I was able to get a really low risk entry here on, what was it, Tuesday, first day of the year. And it came down, kissed it, closed back inside that range. And yeah, I was able to capture a good little profit on the 50% from the high down to here, shaved off a little more than half. And I've got enough on so I can take some covered calls on it. And
Nice.
so, yeah, again, that's a good way to start the year. That and TLT. Futures, on the other hand, not my market, but hopefully it returns. So,
Yeah, you got a back BAC is another one that looks
Bank of
similar.
America. Oh, that's another thing I want. That's another theme. I'm pretty sure. Oh, I did. I actually did talk about this in my letter. If interest rates are going up, you've now got that situation where banks can go back to their, what was it, 5.42, or was it 5.32, where uh, loan it out at 5%, take pay people three. What? Let's ask GPT. I'm gonna ask ChatGPT everything. There's this old meme about banking. What I do with that?
While you're doing that, there's a lot of stuff like we're seeing this week, right? Where the back recaptured that, bounced to 50.
Like what?
Tickers like Met, Nike did that, back did that. MetLife
Mm-hmm.
back tested its breakout.
Yeah, best test is the breakout. Just needs to clear this little
Back
level.
above it this week. Like there's a lot of stuff like that you could have loaded up on to say, like, look, we're back below these key levels, but you gotta kind of show it to me, right? Like, we've got this big pullback, but for 2 weeks, people are able to break it to the downside in the bear market. What gives, right? Why is it not falling apart? When we've had these like 8%, 12% down days on Tesla, right? Why is the market not falling apart? That's where if you see a level like that, you can take some risk and to see what they do over a couple of days with commons, not with options.
It doesn't know. There's something about bankers where they borrow it at 3%, loan it out at 5%, and they're at the golf course by 2. So, yeah, as interest rates go up, banks have been actually getting hurt a lot. Like one of the regional banks that, well, it's not regional, it's getting pretty big now. Truist, that is TFC. It's been getting hit a lot, but it gave up its 50%, but it looks a lot like Bank of America, where it's coming back to it. One of the things that I really liked about TFC is at this point, I'm going to use Yahoo Finance for this. They have.
While you're looking that up, I think we got to pull it up. But if you look at the health insurance stocks, they're getting wrecked this week.
Yeah,
That's
I,
kind of a cyclical
ooh,
change.
I'm still diamond handing UNH. I'm gonna wait for it to break this last
I like
low.
the next where it is right now.
Yeah,
Well, yeah, I like it where it is right now. If you're looking at a new position, I could see someone getting long here at this
that's
level.
the reason that I'm not cutting it is because it basically where I picked this thing up was in I think it was actually it was October around here when it hit the 50%, and I took some profit at the high, so I'm able to hold on to this because I've already made money on it. Most is sold out, but I'm waiting to see it hold this low that it made in October, and it poked it today, but it didn't close below it. But we'll see what happens on Monday. Um,
Yeah. One
I'm
more, and I'm bouncing all over the place, but Lincoln National Corp.
what's that?
That's one that I think it's an ancillary insurance carrier, which in high interest rate environments they make a lot of their income off of actuarial bets like underwriting bets, but they also make money off of profits on reserving. So high interest rate environments, Unum, MetLife, Lincoln National, they're good businesses to have growing earnings. And this was one that just got wrecked because for a stupid reason that I can get into detail if you guys want. But I think that one's a good. You can make a nice bet against today's low on that ticker. That thing could run for a long time.
Mm.
LNC.
Yeah, banks are weird because I know a lot of people have a lot in
Not a
them,
bank
and
though.
oh, it's insurance. You said right?
Yeah.
Well, I think what ends up happening at these levels that they've been killed to, like Truist, TFC, yeah, it was at the low that Truist got to when I last looked at it, I think last week, it was giving a dividend yield of about 5%.
Mm.
LNC right now is a dividend yield of 5.87%.
That doesn't suck if you want to go long term on that against this current low.
Correct. And I think it's, everyone in 2021 could not find yield because the best you could do was like 1% or maybe 1.5% on things like, or anything pretty much. But now you're starting to get into these. And I think this is kind of relative to what we're seeing in interest rates, where you can get a risk-free rate of 30-year bonds versus what these stocks are offering um, in their dividend yields as well. So wherever you want to lock your money up, it's just getting more and more attractive, isn't it?
Yeah, I think so. I think there's a lot of stuff. I mean, look, this market could keep going down, but again, you just kind of know where you can place your stops. And if it
Hmm.
doesn't go down, then you're in at a good level with a dividend return. This is like good opportunities for buying stuff into your IRA, and where your risk.
Yeah, yeah, I think so. I think for the long term, we're starting to get into some really attractive valuations. Yeah, where you're not going to worry if we go down just a little bit more.
Yeah,
Yeah. So as far
yeah.
as YOLO
Actually,
stuff goes,
if I
though,
look at the LNC,
yeah. What?
bet you the LNC, yeah, right after Tinkinson today too. This
Um,
one would have been a good one to buy this morning.
let me take this off real quick, or zoom into it. So if I'm going to try to get this low, I want to mark it off from the low. It hasn't really pulled back in a way that I want it to, but if it comes back to, let's say, 30.33, if this was the high for now, then that would be a good buy that I would put on. And you can pretty easily see the swing from November the 1st. So how I would draw up this trade on LNC would be something to this. This is how I would catch a knife. I would grab it here. First target's going to be, you got that gap level there.
Yeah, you almost got to go to the top of that high, the local high there.
Yeah,
To see like what does that give
at
you?
least there, and then your risk here. You still get a pretty good breadth, pretty wide, pretty wide stop down to 27.29.
I wouldn't. I mean, I know we do this differently. I would do it a little.
You would give it more of a stop or less of a stop? Think I lost you. If you were trying to get a little more profit out of it, you've got this big gap here. It's either going to get up to here or it's going to come all the way back to the middle of the range.
Can you hear me now?
Yeah, I can now. How would you size this?
I would probably buy this like now on any pullback, any small pullback now that I would add at your entry, and I would just give it a smaller stop, basically a close below the recent low, like a day's close, and then I would be willing to try again near the low. Like
Yeah,
I'd be willing to enter now and take two small losses as opposed to one big one, basically.
right. You like to do
But
that.
similarly, I do like to do that.
That's smart. That's smart to take a little bit, knowing that you're going to add some later. So you basically size down your initial. Um, I'm more of an all or nothing kind of thing. But yes, that's good. That's good. That's good. You got anything else I had to add? I'm gonna close things out.
No, I'm taking all over the place today.
No, that's fine, man. I appreciate you joining. So anyway, last heart. Join the Discord community. Let's hang out and share ideas. I like to get ideas from other people, and we do this every Friday. So join me again next Friday, 4 p.m. at the market close. Thank you all, and trade wisely. Have a great weekend. Bye-bye.